So what happens here is we're looking at annuity, right? What is an annuity? Annuity is basically a fixed amount that you get every year for a fixed number of years, right? Unfortunately, I've started this recording now, but of course, we've been looking at quite a lot of topics. We've completed advantages and disadvantages of NPV, and we've looked at test your understanding 5. Okay. And now we're looking at annuity. What I will do is last few minutes, I'll go back to advantages and disadvantages of NPV and test your understanding 5. Right. However, again, I did just mention what an annuity is. When you get a fixed amount of cash flow every year for a fixed number of years, that is an annuity. Okay. So when you get a fixed amount of cash flow every year you're getting 10,000 for 3 years, like this. Year 1 also you're getting 10,000, year 2 also you're getting 10,000, year 3 also you're getting 10,000. That is an annuity. In this specific example, you are receiving $1,000 for 3 years. So this is also an annuity. Why is this an annuity? Because again, you are receiving a fixed amount of money every year for a fixed number of years. So this is also an annuity. The first amount received you will get in 1 year's time, and the interest rate is 10%. What do I mean by this? Now you will just solve this question as usual, like what we did in the previous recording in the previous class, right? So what is the present value, right? Remember, this 1,000 you're getting after 1 year. This 1,000 you're getting after 2 years. This 1,000. So this is all future values, guys. Remember, we did mention in the last class also, and I did mention today also, future value into discount factor is the present value. So we basically need to get the discount factor. And again, the discount factor will be taken for a percentage of 10, for basically 10%, right? So again, if I have to show you the discount factor table again, I think I should keep it open. I have the discount factor table. If I have to look at the discount factor table, how much is the interest rate? 10%. So you have to look at it over here. 10% for 1 year. So just move your finger across that. 10% for 1 year will be, the discount factor for the first year will be 0.9091. So this here, the discount factor is how much? See this? See what I have marked, circled, 0.9091. So here you have 0.9091. Right? What is the discount factor for the second year? Again, 10% is there. Second year is here. Just move your finger across that. And the discount factor for the second year is 0.8264. 0.8264. So again, you have the second discount factor. The second year discount factor is 0.8264. Then we look at the third year discount factor, which is just under that, which is 0.7513. Okay, so multiply it with 0.7513, 7513. And now after this, you will just basically multiply. Remember, future value is equal, future value into discount factor is equal to present value. We've seen this before. So 1000 into 0.9091, 1000 into 0.8264, 1000 into 0.7513 is how much each? Can you tell me? Who can tell me the answers fast? 826 and 0. Yes, sir. Nitish, that's right. So for the first year, it's 9091. Sorry, it will not be 9091. How can it be 9? I think it will be 909.1. Yeah. 909.1. I didn't even do the calculations. Just to always remember, just see if the answer makes sense. 1000 into 0.9 cannot be 9000. Okay, so 909. 824.6. And your 3 will be 751.3. Okay, which is how much? How much is the present value? The net present value, what is it? 2486. Again, the ones who are watching the recording, how did I get this 2486? This is basically all the present values added. 909.1, 824.6, and 751.3. But can I do it this way? Can I make my life a little easier? Instead of one by one multiplying 1000 into 0.909, 1000 into 0.826, 1000 into 0.753, can I do it this way? Because every year the amount is the same. Every year the amount is literally the same. There's absolutely no difference. It's 1000, 1000, 1000 every year. So maybe there is an easier way around this. Maybe there is an easier way around this question. Where what I do is, guys, tell me one thing. The amount is the same every year. Instead of multiplying 1000 with each of them, maybe I'll just multiply 1000 with the total of this, all this. That is 0.909 plus 0.826 plus 0.751. How much will it be? 0.9, add this up. 0.9091 plus 0.8264 plus 0.7513. How much is it? It will be 2.486. That's absolutely right, Nitish. So instead of multiplying 1000 with the breakup, this is the breakup, see? I can just multiply that 1000 with the total. Total is what? 2.486. I'll anyway get the same answer, 2.486. So what I'm doing is, instead, either I can do what I've already done, or in order to make my life easier and faster, I'll just take up the total of all the discount factors and just multiply the 1000 with that, and I'll still get 2486. I'll still get the same answer. Right? So my life has become faster and easier. Here, basically, what is this 2.486? This 2.486 is basically the sum of all the discount factors for 3 years. Which method is easier for you? Which method is faster, do you think? Method green or method red? Which method is faster? Red. Method red. So this exactly, everybody, yes, that's absolutely right. This is, remember, these, what is in green were the discount factors. See, what I'm underlining in green were the discount factors. But what I have circled in red, that is known as something, that is known as annuity factor. So annuity factor can be used to make your life easier whenever there is an annuity, right? Your life is becoming easier whenever there is an annuity. So you don't need to do this one by one. You can just multiply the amount with the annuity factor. As simple as that. It makes your life easy. And the best news is that we also have an annuity factor table. So you don't even need to calculate the individual discount factors and total them. If you want to solve this question, all you have to do is look at the annuity factor table. Can we do that? Yes, I'll show you. Remember, it was 10% for 3 years. So there is a table known as the annuity factor table. See here, 10% for 3 years. Again, just move your finger across. You will see the annuity factor is 2.487. So you have it. Annuity factor is there. Annuity factor is 2.487. So you have it. So this 2.487, 2.486, you did not even have to add up like this. No need. All you have to do is pull out your annuity factor table and multiply that amount of 1000 with the annuity factor. You will get the present value. So 1000 is multiplied with the annuity factor 2.487. Now that it's okay, point difference is fine. You will get the answer 2.487. So this answer, which I spent about 2 minutes solving, I can get the same answer in less than 1 minute. Can we try it? Can we see if we are getting the same answer in less than 1 minute? Yes. The amount is how much? 1000 rupees. It's 250. Okay. The amount is 1000 rupees. You just need to know the annuity factor for 3 years at 10%. How much is the annuity factor for 3 years at 10%? 2.487. So simply multiply that amount with 2.487. 1000 into 2.487 is 2487. Did we get the right answer? Can we check? Yes, we got the right answer. We got it in less than 1 minute, in a few seconds. So whenever there is an annuity, you don't need to one by one calculate the discount factor and multiply, set and multiply. It's not required. You just pull out your annuity factor table and get the answer in less than 1 minute. I took just 20 seconds totally to calculate this. So with that, annuities are done and discounting annuities illustration 2 is done. Annuity. Again, the ones who are watching the recording, I hope annuity is clear. But obviously, you have to make sure if you haven't watched the previous recordings, obviously, for things to be in a good flow, make sure you watch the previous recordings. It's just two recordings. So far, this is the third class, right? So obviously there's not much you have missed. So go back to those two recordings, watch them, and then come back. So annuity, I've explained what it is, and I've also explained illustration 2, with which our life is easy. Now again, the textbook has tried to give you a formula for annuity factor, but again, before using the formula as such, I don't normally use the formula. I mean, I just find the table to be very easy and interesting. But again, we will definitely implement the formula also. Please, some assignment mention on the LMS. Okay. So with regards to LMS assignments, as in what to do, you mean how what to study today, what to do, what to study, which questions to practice? Are you talking about that?
Yes, sir.
Yes, we will share it. We'll definitely do that. Okay. Again, a payment of 3,600 is to be made every year for 7 years. The first payment occurring in 1 year's time. So again, you see, you're getting the same amount every year for 7 years. So this is proof that this is an annuity. So it's 2:53. Can we try to get the answer in less than 1 minute? Let's see how many of you can take up the challenge. It's 2:53. Okay. 3,600 is the future amount. Multiply it with the annuity factor. Annuity factor is again 8% for how many? 7 years. So 8% for 7 years. 8, 7. So just move your fingers across. It is 5.206. So the annuity factor will be 5.206. So again, 3,600 into 5.206. How much is it? 3,600 into 5.206. Again, I'm getting what answer? 3,600 into 5.206. It is 18,741. That's it. That is the present value. We got it in less than 1 minute. 18,741. That's it. Test your understanding. 6 is over. Okay, but of course, you can also implement the formula. Obviously, remember using the table is always easier, always faster. We're getting the answers in less than 1 minute each. But you can also always use the formula. The annuity factor is equal to 1 minus 1 plus R. Here R is the rate, 8%. 8% is 0.08. So you can simplify that as, again, do it in your calculator. 8% is 8 divided by 100, which is 0.08. And 1 plus 0.08 is 1.08. I basically simplified this for, I think, Neharika, who wanted me to use the formula. So that is how you simplify. Again, I'm not able to do it here, but raised to minus n. N is how many years? 7 years. Divided by R. R is again 0.08. Now all you have to do is throw all of this into your calculator, right? And get the answer. So just try it. I've already got answers. Where was it? It is how much percent? 8%, no? 8%, 7 years. I've got 5.8%, 7 years, 5 point, I've got 5.2125, not sure why, but the answer is 5.206. I've got 5.2125. Let me see your answers. 5.206. Okay. Oh, Kittu, you got 8.9. 8.9 will be wrong. Kittu, can you do the calculation again? Yes, 5.206 is the right answer. For some reason, I've also got 5.2125. But again, we will be using Excel also to see if your understanding is right. Okay. In fact, in all the exam kit solving questions, we will be using Excel. But for now, you just need to know the formula. And again, you've got the discount factor. Now you simply multiply 3,600 into 5.206 and you'll get your answer of how much was it? 18,000 something. That's it. So test your understanding. 6 is also done. Six. Now again, we've talked about annuity tables. So again, there's another question and they want you to use both the formula approach and the table approach. They want you to try both. So Nitesh, 1 minus 1 divided by 1.08. Let me check. Yes. 5.2. Yes, that's absolutely right. Right? So again, what are we going to do here? We're going to look at both the formula and the discount factor method. But here, everything is now the same. There's nothing new here. To test your understanding 7, you can try on your own. Right? What test your understanding 7 is, what is it saying, all of that. Try test your understanding 7 completely on your own. Let's me see who gives me the answer first. I've got the answer. It's 10,000. Sorry, 107,091. Okay, Kitu.
It's 3 o'clock.
Let's see what about others. And try to use both the methods and see if you're getting the right answer. Present value is equal to annual cash flow into annuity factor. Yes, it's going to be 11,400 into the annuity factor. And you have to use the table to get the annuity factor. Everybody, I'll give you 1 minute. Yes, guys, that's absolutely right. Now, the next thing we're going to look at is something known as perpetuity. So far, I hope so good. Let's just ignore these 5 things and assume that we're starting a fresh new class. Okay. In another 25 minutes, you will have the break. And I want to move to the 4th chapter today. Let's see. What is a perpetuity? Forget perpetuity. In simple English, perpetually means basically forever. Perpetual means, in simple basic English, it is forever. Yes, that should be right. There should be no problem. Oh, yes, Arisha, what's your question?
So the question is, in test your understanding 7, it's with the first payment occurring in 1 year's time. So we won't take any effect of this line in the question.
Here it says the first payment occurs in 1 year's time, meaning what he means by 1 year's time is this question is very straightforward because sometimes what happens is, okay, this is a good question, but this is something we will definitely look at shortly, but I will explain it to you in brief, right? When you invest, right, you want returns. Cash flows you want. Okay, you want at least cash flows. Cash flows coming back to you. Cash inflows you want. Inflows, you want money coming back. But it's not necessary that you're investing, say, 50 lakh rupees now. Now means time zero. Time zero, again, for those of you who are watching the recording, time zero means now. Now, 50 lakhs you are investing. So it's going out. That's why I'm putting it in bracket. It's out. It's gone. It's an outflow. But maybe your first inflow of cash will be in time 4. Maybe you'll get nothing in time 1, time 2, time 3. That is year 1, year 2, year 3. You will get nothing. Maybe. Right? Maybe your first cash inflow will only be in year 4. So, in order to clarify and in order to make sure that you know when you're getting the money, that is why the question is saying that the first payment occurs in 1 year's time. It immediately means that your life is very easy and there's nothing complicated, and your first payment is in time 1 and onwards, time 1, time 2, time 3. So as of now, our life is easy and we are always assuming that the first payment comes within 1 year. Arisha, clear? Yes, Nitesh, that's absolutely right. Aisha, is this clear? We will look at a later topic, how and what to do if money comes in, say, cash flow comes in year 4, what to do? How do you then calculate? That we will look at shortly. But this, for now, our life is easy. You're getting the cash flow in the first year itself. Clear, Anisha?
Yes, sir.
Okay, very good. Now, in English, perpetual means forever. Okay, you will live there in perpetuity means you will live there forever. Okay. Now a perpetuity means an annuity, but forever. Right? Perpetuity is an annuity forever. An annuity is what? An annuity is basically a constant or a fixed amount of cash flow for a certain number of years. A perpetuity is an annuity, or rather, it's wrong to say it's an annuity, but it is definitely a fixed amount of cash flow, but it's not for a certain number of years. Perpetuity, I'm not good with spellings. Fixed amount of cash flows, but this is not for a certain number of years, not for 7, 8, 10 years. This is forever, right? At least for the foreseeable future. That is until and unless we can see the future. For the foreseeable future, you're getting this amount. No, Kittu. Here it will, perpetuity will not be for X number of years. Perpetuity will mean forever. For as long as of now, it's forever. For example, if you ask me for how long I'm going to teach, as of now, I will say forever. I don't know, maybe after 15 years I might stop, but for what I can see, from what I can see, I will teach it forever. Right? So a perpetuity is a regular inflow of cash. It's an annual cash flow that happens forever. Right? And now we will look at the perpetuity, the present value of a perpetuity. We have something known as a perpetuity factor, and the perpetuity factor is very easy. First of all, you need to know what a perpetuity is. Then you need to know what the perpetuity factor is, right? Perpetuity factor is 1 divided by R. Again, ignore growing perpetuity, forget it. As of now, our life is easy. Perpetuity is an amount that you receive every year forever. Right? So let's look at test your understanding 8. Right? We're going to look at test your understanding 8 and what has to be done. Remember, you're going to ignore the second part of the question. Don't look at things that will scare you. Just look at part 1. 3,000 you are receiving in 1 year's time and forever. In this case, what do you do? $3,000. Yes, Arisha, that answer is right. But what do you do? 3,000 is the cash flow. Remember, present value for a perpetuity is, what? Cash flow divided by R. See here, this, if you want, you can put it in a box. The present value for a cash flow is this much part, what I'm putting. If you want, you can make a note of it and put it in a box. But the present value of cash for perpetuity is cash flow divided by R. R is the rate. And here the rate is 10%. So the present value for this perpetuity, in our case, is cash flow is 3,000 divided by R. R is 10%, which is 0.1. So 3,000 divided by 0.1 is 30,000. That's it. End of story. Himanshu got second part also, but I would want to explain that and then probably ask you to solve it. Right? Now, what is growing perpetuity? See, I'm getting 3,000, 3,000, 3,000, 3,000, 3,000, like it's 3,000. But the thing is, it's like rent, rent. Just think of like even my office rent here. Okay, Finchartered office. We have a rent of say 50,000. And as of now, at least, I will be staying here in perpetuity. Right? So 50,000 forever. I have to pay. But in our clause, in our contract, it mentions that yes, you will pay 50,000. So I mean, that's why I said it's kind of like an annuity where you're getting a constant amount. But where this kind of changes slightly is yes, you'll pay 50,000, but to that 50,000 in our contract, yes, Kitu, in our contract, to that 50,000, there will be a gain of, I don't know how much exactly in our contract, but there will be a gain of 1% every year. Every year, he will increase the rate of 50,000 by 1%. So 1% will grow year after year. And that is where the perpetuity keeps growing year after year. Right? And this is what a growing perpetuity is. Every year you're going to be paying this X amount forever, but year after year, every year there is a growth. Again, an example could be the rent. Every year that rent increases by 2%. So right now it's 50,000. Next year I'll pay 50,000 plus 1% of 50,000, which is 1.01 into 50,000. So I'll be paying next year onwards 5,500. Then again, there will be a 1% growth in that. So 50,500 into 1.01. I'll pay 51,005. Every year, there will be a 1% growth. Right? So that kind of a perpetuity is known as a growing perpetuity. Very good, Nitesh. That's absolutely right. Right? Now, how do you get the calculation? Remember, it's very simple. Very, very simple. Go back to, again, I don't, probably you people have already checked the formula. But the formula, what did I say? It was cash flow divided by R. Here, you'll just add 1G to it. Basically, what you will do is cash flow divided by R minus the yearly growth. That's it. So you've literally just added that red part which I've highlighted, just that you have added. Literally, that's it. R is 10, growth is 2. So what is it going to be? 3,000 divided by 0.08. See, 30,000. See, the present value will be, again, this I'm removing. Okay. But it's going to be, present value is going to be 3,000 divided by R. R is 10% minus 2%. So 10% minus 2% is 8%. And 8% on your calculator, do it. 8 divided by 100 is 0.08. So 30,000 divided by 0.08 is 37,000. Sorry. 30,000 divided by 0.08 is Sorry, not 30,000 guys, 3,000. No wonder I'm getting the wrong answer. 3,000 divided by 0.08 is 37,500. So your life is simplified by just looking at forget even that box. Just you add 1G. This is it. Simplified. This will sort out these type of questions, which I've put here, marked. Okay, so we've looked at test your understanding 8 as well, both parts, 1 and 2. I hope so far so good. I hope very easy, simple. Hi Osama. I wasn't able to see you in the first part. Abdullah also I wasn't able to see you. Guys, please make sure that either you are watching. Try your best to join the class on time. But if there is a problem, make sure that the missed part, you watch the recording. Otherwise, things will be a little troublesome for you. Okay. So that is all. That is it we've seen so far. This is what we saw, guys. Abdullah, Osama, the few people who just joined. For second part, which year's PV will be the answer? Second year. Which year's PV will be the answer? No, basically the present value, not which year's PV. This we are trying to find the present value now. Value now we're trying to find, right? That's it. So guys, these are the 8 topics that we completed today. Again, today's objective is to complete this chapter and move to the 4th chapter, and probably by the next class move to the 5th chapter also. Okay, guys, this much good, all easy, life is simple. Quickly go through what you have noted. Just 1 minute. Now, guys, we're going to move to the one that was not recorded. I will definitely do it towards the end so that it is recorded. Now, guys, before moving to advanced and delayed annuities and perpetuities, today I'll not do advanced and delayed annuities and perpetuities for the simple reason that I want you to be 200% confident with annuities and perpetuities first before we're advancing you, right? So this is a topic that I would want to come back to, right? Once you are happy with annuities and perpetuities, it's a very small topic. It's not very difficult. It's very easy. But your understanding of annuity and perpetuity is very, very important. I don't want you to just look at it, just for the sake of looking at it. You need to be really comfortable and really relating with the topic. Now, today we're looking at what internal rate of return is. Okay. How many of you have heard of internal rate of return? Back in FMA, you used to hate advanced and delayed annuities. Okay. I hopefully now it should be interesting for you. Yeah, IRR you would have seen in MA. Okay. What is IRR? Okay. See, this is like this. And I'll try to give you an analogy to explain to you. What analogy can I give you? It's like this. Okay. If you I don't want to just read the textbook. So I'm just thinking of an interesting analogy where, say, you have what? Probably we say that you have to watch the recordings. I mean, this is not a literal example, but this is just, it's an analogy for you to understand what I'm trying to say, right? But not even recordings, okay? It's like you have to say, okay, see what here we are talking about is, if you have a high interest, your, before we look at IRR, okay, let's for the next 3 minutes just kind of do this exercise. Okay, and the exercise is this. Do the sum, test your understanding 5. Okay, all of you do test your understanding 5. But do it 2 times. One is where the R or interest rate is 8%, and the other is when R is equal to 15%. Do it 2 times and tell me what present value, what answer do you get? You can use, again, just the discount factor table. Again, is this an annuity? No, this is normal discounting, right? You're getting 10,000 in 4 years' time. So discount it and tell me what answers are you getting for 8%, and what answer do you get for 15%? Okay, if you want, I can show you the discount factor table also, and I've got answers. So the answer is, for 8% is 7350, and for 15% it's 5718. For 8%, the answer is 7,350. Your present value, you're getting 7,350. And for 15%, you're getting 5,718. So as you're able to understand, for a lower interest rate or cost, obviously if your cost is lower, you're getting more cash in hand. But if the cost is higher, you're getting less cash in hand. And this is common sense. Right? As of now, I just want you to reflect on this. As the interest rate goes up, as the cost of capital goes up, the cash, the present value goes down. Just reflect on this. We have just a few seconds before the break. And once you are comfortable with this, we will come back from the break at 3:35 p.m. in exactly 10 minutes. And we will look at what IRR is. Okay, it's 3:25, guys, again, as per the timetable that we've noted here. 325 to 335 will be your break. So you don't need to leave the meeting. Stay in the meeting, come back by 3:35 and we'll continue. Yes, guys, come back. It's 3:35 p.m. now, meaning that we will have to continue. Okay. Just confirm that you're back. Just type it in this, let me know somehow. Okay. Now, what we have to look at is again IRR. Okay. There's a project. Okay. Going back to the basics, forget all this is okay. Okay. Going back to the very basics. If the interest rate is 8%, you will earn, again, interest rate, it's costing you money, right? If the interest rate is 8%, you will earn 7,500. I'm putting 7,350 because it's a good thing. You're earning it. The present value of your earning is 7,350. It's a good thing, right? But if a project costs 15%, then your earning is lesser. Basic simple analogy is this. Scenario one, if you sell a pen for 10 rupees and the cost is 3 rupees, the profit is 7. Compare it with scenario 2. If you sell something for 10 rupees, same 10 rupees, the same pen you're selling for 10 rupees, but if the cost increases and if the cost becomes, say, 4 rupees, your profit will go down. It becomes 6 rupees. You see? What is costing you, I'm putting in red. So it's like you are bleeding. That money is going out of your hand. As you can see, when the cost goes up, cost is going up, the profit is going down. And that's exactly what is happening here as well in this box. You see, when the cost of capital goes up, the return that you get from the project is down. When the cost of capital is down, the return that you get from the project is high. So again, just like in this example, which I'm putting in my box now, as the cost increases, the return is going to go down. Same way in this box also, as the cost of capital rises, the return from the project is going down, right? So you can do this, I challenge you. But do this and tell me what is the present value if R for the same question is 25%. Which question did I give you to do? I think it was test your understanding 5. For the same question, can you calculate and tell me what is the return? What is the return in terms of present value you are getting? In terms of today's value, what is the worth of this 10,000 in terms of today's value? If R is 25%, who can tell me the answer first? Others, are you sure it's 4,096? It has to be, I feel, lower. Who can tell me? 8%, sorry, 25% you are receiving in 4 years' time. So, %25% you're getting in 4 years' time. Anjana also feels it's 4,096. Yeah, okay, fine. So again, you can see it's going down further, right? And try it if R is, say, 0, I'm putting it 0 here. Say if R is 2%, then what is the present value? Quickly. How much? Again, I have answers. 9,238. As you can see, what I've been telling has been proven. As the cost of capital is going up, the present value is going down, right? Now, what I want to know is, say, for another question also we will practice and then we will be comfortable. Okay, I don't want to open a textbook question. But as you can see, this is the situation. Maybe, for example, maybe if R, maybe if it is 50%, I'm just giving an example. I don't know. I didn't do any calculation. But maybe if R is 50%, the present value will be less than 0. Maybe it will be a loss. Maybe it will be minus 12,000. Maybe I'm just saying. I don't know. Right? So, guys, again, I hope my screen is visible. Right? If when R was 2%, you were getting more. You were getting 9,000. The present value was 9,238. When R is 8%, 7,350. When R was 15%, 5,718. When R was 25%, 4,096. And maybe this is not a real thing. I'm just saying maybe. When R is 50%, maybe you will get minus 12,000. Now the problem is, okay, where is the point where neither do we make a profit nor do we make loss? Where is the break-even point? Where is the point at how much cost of capital, at how much R, at what percentage of R do we neither have a plus positive NPV nor do we have a negative NPV? At what point, at how much percentage of R do we have a net present value of 0? Now, this is a very interesting question. Because you have to go like going fishing, like going fishing. So again, you have to do, that at 50% your answer is negative. At 25% it's positive. So you know that somewhere between 25 and 50%, you will get a net present value of 0. So you have to again calculate it manually. So basically, at what rate do we have a net present value of 0? Because that will definitely help us decide whether a project is good or bad. For example, if I tell you that at 18%, NPV is 0. You know this. you know that at 18% NPV is 0. Meaning, anything more than 18%, it will be a loss. Because as we've seen, as the rate increases, NPV decreases. So anything more than 18%. So now you know at 19%, you will be having a negative NPV. And at anything less than 18%, you know at 17%, you will have a positive NPV. So if you know at what percent your NPV is 0, it becomes very easy to decide whether to do a project or not. Why? Because anything less than 18%, we know that there will be a positive NPV, so we can accept that project. Remember, at 18%, we are 0. So any rate at less than 18% will give us a positive NPV, so we know we can accept. So we don't need to sit and remember so many percentages. We just need to know one percentage. In this example, that one percentage is 18%. This 18%. You know that at 18% you will get nothing. It will be 0. So anything less than 18% is positive. And you know now that anything more than 18%, you will get a negative NPV. So you know any project, if it is less than 18%, accept it. Even if it is 16%, 15%, 14%, 13%, 8%, accept it. 8% will be beautiful because 18%, if it is 0, 8% will be a very high NPV. But you know now that anything less than 18% will give you a positive NPV. But anything more than 18%, you know for sure, you don't even need to do the calculation. You know 100% that anything more than 18% is negative. You don't need to do the calculation. Why? Because you know that 18% is 0. So if it is more than 18%, you already know that it is negative. So guys, is it helpful to know which point our NPV, at what percentage our NPV is 0? Do you think it is helpful to know that for us to decide whether to invest in a project or not? Do you think it will be helpful?
Yes.
What about others? Himanshu, Jigyasa, Nitesh, do you think, Osama, do you think it will be helpful to know at what percentage do we have an NPV of 0? Will it help? Himanshu, Arisha, yes. That percentage at which you have an NPV of 0 is what is known as the, any guesses? IRR. So basically what I have, I'm just going to clear the screen. But what I have defined here is basically the IRR. That percentage at which the NPV is 0. And in my example, 18% was the IRR. So if the cost of capital is less than IRR, we will accept the project. If the cost of capital is less than IRR, we can confidently accept the project. Right? And if the cost of capital is more than an IRR, don't calculate. You see, FM is making your life easy by giving you one rate. Simple, as simple as that, life easy. Any project more than 18%, I will reject. No need to sit and do any calculation here. Life has become so easy for investment appraisal. Anything more than 18%, reject. I don't need to calculate, I know it will be negative. Any project Again, if the cost of capital is less than 18%, I know for sure that it will be positive, so I can accept it. This is IRR. Now I can show you the textbook if you've understood what I have explained. IRR is the discount rate at which the NPV is 0. Accept the project if IRR is greater than the cost of capital, and that is what I mentioned here. See, again, if IRR is 18% and your cost of capital is 17%, you will accept the project. In other words, you will accept the project if cost of capital is less than 18%. If IRR is more than cost of capital, basically, you will accept the project. That's it. IRR is done. Okay, so I hope all of you are clear with what IRR is. But now, coming back to the calculation. Again, at 8%, we are positive 7350. At 15%, we are positive 5718. I'll remove this because it's a little misleading. It looks like it's negative. At 25%, we are positive 4096. At 50%, we are negative 12,000. So do you think at 6,000 we will have, at 6,000, do you think we will have an NPV of 0? Do you think so? At 6%?
No.
No. Nitesh, one more time about IRR. What is IRR? It is that rate where your NPV is 0. Right? For example, if at all at 17% you have a positive, I've already explained to you that as the cost increases, the profit decreases. In this example, I've already explained it. Right? So here at 17% you are positive. For example, this is at 17% if you're positive, at 18% you are 0, at 19%, obviously if the cost increases, if at 18% you are 0, at 19% if your cost has gone up, automatically you will be negative. Okay, so what I want to know from all of you is, where do you think, at what percentage do you think your NPV will be 0? 8%, 15%, 25%, 15%, 6%, 1%, 100%? At how much percentage do you think you will have an NPV of 0? Because here I have given you some clue. 8% is 7350, 15% is 5718, 25% is, as the percentage is going up, NPV is going down. So who can make a guess? Again, there is no calculation to do. Who can make a guess and say at how much percentage will we be at 0? Make a guess, everyone. Everyone. Nitesh, you understood? Can you make a guess also? Only 4 people have made a guess. I have like another 6 people. What is your guess, Nitesh? 38 to 42. Himanshu, Deepika, Janvi, near 40%. But the problem is, we cannot sit and make guesses. Here right now we are making guess. But we don't have so much time. Okay, you'll make guess and then you'll calculate. And we don't have time to sit and calculate for 35%, 36%, 37%. We don't have time. And that is why FM has made your life easy by giving you a formula. And the IRR formula is what? The IRR formula is, as you can see, IRR is L. This is the formula, where L is the, basically you will take two rates, the lower one and the higher one. You know, at 25% you are positive. Okay, so this can be your lower rate. And you know, at 50% you are negative. So this can be your higher rate. So you take two rates, the lower and the higher, where L denotes the lower rate, H denotes the higher rate. So according to my example, L is 25%, H is 50%. And obviously, for the lower rate, there will be one NPV, and for the higher rate, there will be one NPV. Here, in my case, the lower rate NPV was 4,096. So I will call it NL, the NPV of the lower rate. In my example, NL is 4,096. And in my example, NH, the NPV of the higher rate, is NH. So you need these four ingredients, that's all. And you can easily calculate IRR. Now again, in this case, I don't want you to calculate for this example because 50% minus 12,000, it was a dummy thing. It's not the real answer. I just told you an example. But if you have these four ingredients, one lower rate, one higher rate, and the NPV of the lower rate and the NPV of the higher rate, we can substitute it in this formula and get the IRR. Before I move on, the question is everybody clear with everything here, all these 9 topics? Is everybody very comfortable, including IRR? If anybody wants or has a problem with something, let me know. The ones who are comfortable and happy, just say yes. Quickly. So 1, 2, 3, 4, 5, 6 of you are happy. What about the remaining 4? Let me know. Himanshu, we haven't heard anything from you. What about Jigyasa has mentioned, Janvi, Nitesh, we will use 25% Kitu, right? But that would translate to, okay, translation we will do, but 25%, the lower rate we will use basically. And I don't know which one, yeah, 25% would be the lower rate. So everybody is clear? Again, yeah, sure, I can explain one more example I can give you to explain IRR and then we can continue, right? Okay. Remember one thing, this is not only for Nitesh, this is for everybody. As expense goes up, profit goes down. This is common sense. Nitesh, you agree with me? When expenses go up, savings will go down. Forget profits. Let's look at us in our individual lives. As expenses go up, savings will go down. Let's use the same logic. If cost of capital goes up, your return will go down. And we can prove it, Nitesh. In all these previous examples, I challenge you. In fact, the ones who are watching the recording also, it's an open challenge. I challenge you. Do the same question for a higher interest rate. As the cost of capital goes up, the answer,
It's 4 o'clock.
The answer, the NPV will go down. Just like as expenses go up, savings go down. So yes, at 8%, we've had an NPV of 7350. But as this goes up, Nitesh, as the cost of capital goes up, the NPV will continue to go down, down, and down, just like as expense goes up, savings go down. Is this clear, Nitesh? This much? Yes. Now, what will happen is there will be a certain percentage. Obviously, you want a positive NPV. Nitesh, you want to invest in a project that gives you positive returns, correct? Not negative returns. So at 8%, you know for sure that you are getting a positive NPV of 7350. And maybe, for example, Nitesh, for example, I don't know, I haven't done the calculation, but maybe for 25%, again, maybe for 25%, maybe you will get a negative NPV of 4,000. Do you think it is good for you? Negative NPV of 4,000? No, right? So this cost of capital is too high for you. It will, instead of looking at individual cost of capitals, it will help to know one cost of capital where the NPV will be 0. It will help to know one cost of capital where NPV will be 0. For example, let me remove this. But for example, at 8% you are positive, at 25% you have a negative NPV of minus 4,300. So it will help us to know at what percentage NPV is 0. Because at 8% it is positive, at 25% it is negative. So at how much percentage NPV is 0? For example, from what I can see here, maybe, at 16%, NPV is 0. So you know that if the cost is 16%, you will neither get positive nor you will get negative. But what if the cost increases to 17%? Nitish, NPV will be what will happen to NPV if the cost has increased to 17%? What will happen to the returns? Remember, when the cost goes up, what happens to savings? Savings go. What happens to savings when cost goes up? Savings will go down. So see, at 16%, you know that your NPV was 0. So at 17%, do you think it will be positive or negative? It will be negative. And what about 15%? Think about it, Nitesh. If for 16% it is 0, if the cost is 16%, yes, very good. So here you will have a positive NPV, right? So instead of knowing all these costs, cost of capital, it is helpful to know one rate at which the NPV is 0. That rate at which NPV is 0, we are giving it a name. I don't want to call it every time, no. This rate at which NPV is 0, this rate at which NPV is 0. I want to save energy. So I will just call it IRR, the internal rate of return. And once you know your internal rate of return, Nitesh, you know at 16% you are 0. So anything less than 16% will be positive. So if the cost of capital is less than 16%, can you accept the project or reject it? Anything less than 16% will be positive. So now you know 14%, can we accept or reject, Nitish? Accept. Very good. And what about 16.5%? Should we accept or reject? Reject. This is how IRR helps you. So IRR, again, from the textbook's point of view, not point of view, basically in the textbook's words, is the rate at which the NPV of an investment is 0. And as I did mention, you can accept a project if the IRR is greater than the cost of capital, meaning the cost is lesser. So definitely the NPV will be positive. IRR is, so for example, here the cost of capital is I'm not quite sure, Kitu, but maybe we will do the calculation. But great if you have done the calculation and you got the right answer. Right? See, Nitish, in this example, 15%, assume it's the cost of capital of your project, and you know the IRR is 16%. So 15% means that, very good, our cost of capital is lesser than the IRR, meaning we can accept the project. Nitish, is this clear? Perfect. Now, instead of sitting and manually doing it, Nitish, you have to manually calculate, like how we did in the previous sums. Oh, for 6%, how much is my, for 8%, what is my NPV? For 10%, what is my NPV? For 11%, what is my NPV? You have one choice. That choice is one by one, calculate NPV for each percentage. Calculate it for 1%, calculate for 2%, calculate for 8%, calculate for 9%, calculate for 10%, try it for 12%. See where do you get 0, and that will be your IRR. See where is the NPV 0, and that is your IRR. But do we have so much time? No. Therefore, we have a formula. And that formula is this, which I had put in my box. Nitish, now is it clear? 200% IRR. If you have understood IRR, the third chapter is over and I will be successfully moving to the fourth, obviously with some practice of the sum. So I will clear this. Again, you can make a note of the formula, guys. In another day or two, we will be uploading the materials in the LMS. Okay, just make a note of the formula. Kitu, you gave me the answer for test your understanding 9. I'm not quite sure. I'll have to do the calculation. Okay, for the first illustration. Okay, the old one. Fine, I'll check. Okay, guys, so with that, IRR is over. Now we're going to look at test your understanding 9. Potential projects predicted cash flows give an NPV of 50,000 at a discount rate of 10% and minus 10,000 at a rate of. So this question is so straightforward. See, at 10%, you have a positive NPV. At 10%, you are positive. Your life is good. But I'm getting answers already. Very good, guys. But at 15%, your life is going bad. You have a negative NPV. So obviously the answer, I already know that the answer has to be between 10% and 15% because 10% is positive, 15% is negative. So obviously 0 will be between 10 and 15%. So I already knew that the answer is between these two. It cannot be 9%. It cannot be 16%. One option is to individually calculate how much is the NPV for 11%. How much is the NPV for 12%? How much is the NPV for 13%, 14%? Individually, I will calculate. Or I can simply substitute this information into this formula where L is the lower interest rate. Here, L is 10%. H is the higher interest rate. Here, H is 15%. NL is the NPV for the lower interest rate, which is in this case 50,000. NH is the NPV for the higher interest rate, that is for 15%. So NH is in this case negative 10,000. So substitute this information into this formula, right? Which is going to be L, that is 10%, plus, again, now you just have to substitute it, guys. Basic calculation, put it on the calculator, substitute it L, that is 10% plus NL. NL is 50,000. So again, 10% plus NL is how much? 50,000 divided by NL minus NH. 50,000 minus 10,000 into, again, I'm not able to, that's what I'm telling you, basic calculation here, I'm not able to. Okay, anyway, I'll draw it and show it. Into H minus L. Again, into H. H is how much? 15% minus 10%. How many of you got the answer? I got 1, 2, 3, 4, 5 answers. Others, can you try and let me know if you got the correct answer of, again, everybody is telling it's 14.17. It should be 14.17. Yes. Kittu got, Sadia got, Osama got, Arisha got, Nitesh got, Jigyasa, Janvi, Anjana. Can you substitute and get the answer? Very good. So with that, this is what IRR is. Okay. Right. Now, again, let's look at test your understanding 10. With which we can move to advantages and disadvantages of IRR and complete. I think there's one small topic, yeah, NPV versus IRR and all that. But let's look at test your understanding 10. A business undertakes high risk investment and requires a minimum expected rate of return of 17% per annum. A proposed capital investment has the following expected cash flows. Calculate the NPV of the project if the cost of capital is 15%. Calculate the NPV of the project if the cost of capital is 20%. Use the NPVs you have calculated to estimate the IRR of the project. Recommend, or now basically this goes back to basic calculations that we have done so far, right? Again, unfortunately, I mean, this is going back to the very basics, right? Especially part 1 and 2 of the question. Part 1 and 2 of the question, remember, right now I'm investing 50,000 at time 0. Therefore, of course, the discount factor, this is invested now. I mentioned this yesterday. If it's invested now, the discount factor will be 1 itself, and the present value of also it will be 1%, 50,000. The cash flow is 50,000. It is invested now. So what will be the value of that now? Same 50,000. Then first year you're getting, again, going back to yesterday's class, basically. This is a revision of yesterday's class. The discount factor here will be, again, just use the discount factor table. 17% for 1 year. Again, who can tell me what is the discount factor? You have to refer to the discount factor table. %17% for 1 year. Again, if I have to show it to you. %17 for 1 year. For whatever reason, I'm not able to zoom in. But 17% for 1 year, you can see it over here. It's 0.8547. Right? So 0. How much? 8547. So 18,000 into 0.8547 is how much? I want to see who gives me the answers first. $0.8547 into 18,000 is how much? Quickly, all of you do the calculations fast. Second one is 25,000 again into the discount factor. Discount factor of 15%. I'm sorry, guys. Why did I take 17%? The question mentions, oh yeah. But here we are asked to calculate the cost of NPV if the cost of capital is 15%. Right? So for 15%, I'm sorry, not 17%. We are expecting 17%, but we have to look at, for this project, 15% for 1 year will be 0.8696. 0.8696. How much will it be?
$15,652.8.
15,652. Very good. So again, it is 15% for 1 year, 0.8696. Can also be taken as 0.870. So if you round off, obviously there will be a slight difference in the answer. Okay, then 25%. Again, if it is 25,000, if it is 15%, the cost of capital, 15% for 2 years is 0.7561. So 0.7561. So 25,000 into 0.7561 is how much? 25,000 into 0.7561 is, no, not 1802. 25,000 into 0.756, 18,902. Very good. Same way the third year. Basically, this is a revision of the previous class. 20,000. If it's 15% for 3 years, then it's going to be here again. You can see under 15% for 3 years, 0.6575. So how much will it be? 0.6575 into 20,000 is how much? $13,000. Yes, 150. 13,150. Same way, fourth year, 10,000 into, again, what is the discount factor? 0.5718. So 10,000 into 0.5718 will be 5,780. So what is the NPV? What is the net present value? Who can calculate and tell me? You have the entire thing I've done. You just have to do basic add and subtract. $15,000. Again, we've done this in an earlier class. This is a revision of that. Yes, the NPV is positive 3,422. Very good, Osama. Osama gave me the answer first. Now we will redo the same thing, but for what? For a cost of capital of 20%. So I will leave, I've done the first part of the question. Second part of the question, I want you to do it and tell me what is the NPV. Everybody has to calculate. And if you need, you have the discount factors also in front of you. Ignore the first one because that is for the first year. Sorry, for year 0. After that, 1, 2, it's there in order. Right? So this is over here on the screen. Just move this a bit. Yes. So you have the discount factors, 20% here. Ignore this because that is for time 0. After that is 1, 2, 3, 4 in that order. Arisha has already given the answer. Others, everybody calculate. Second part of the question, I'm leaving percent plus NL. NL is 3422 divided by NL, 3422 minus 1, 2. So minus will become plus. Minus 1, 2, 4, 2 into 20 H minus L. H is 20, L is 15. So 20% minus 15%. So if you do this calculation, the answer will be how much? Do the calculation. It will be 18.68%. I've got 18.68. Just check if all of you have got this answer. So guys, we've got the IRR of 18.68%. So obviously, if we are taking what? On Excel, it's showing something else. What is it showing on Excel? Supposed to show 18.6. No, impossible. 6,24,000. No. There has to be a calculation mistake. But it cannot be that much, right? This is the answer. We will again, for your practice in the kits and all that, we will definitely use Excel also. But just check your calculation. Don't put it on Excel for now. Do it on your own and see. This should be the answer that you're getting. right? So guys, this is what IRR is, right? So again, we've looked at test your understanding 9 and test your understanding 10. Test your understanding 9 and test your understanding 10. Now we will look at advantages and disadvantages of IRR calculation alone. You're getting the wrong answer. We'll look at that. Okay, there has to be, you understood the concept, you understood, logic, calculation, I'm sure there is a mistake in the calculation. Okay, so now we're going to look at advantages and disadvantages of IRR. Again, the advantages are the same as we saw earlier in NPV, because again, we are technically using the same concept. Multiple advantages are the same. Again, you're considering the time value of money, because I've explained these advantages and how they are advantages when I explained NPV. I'm not going in too much detail here. Okay. Uses cash flows, not profits. We saw that also. Considers the whole life of the project. We saw that also. And one plus point of IRR is, as I said, once you know the percentage, anything less than the percentage, anything less than IRR means a positive NPV. Anything more than the IRR, any percentage more than the IRR means a negative NPV. So as I told you earlier, this is 1%. If you know this 1%, you will be able to decide whether to accept or reject a project. And therefore, that is the second advantage it talks about. It is a percentage. If you know this 1%, it is easy not only to understand, but also to kind of implement it. Right? And obviously, this is just common sense, which I told you. If the cost of capital is less than the IRR, it means that you are going to get a positive NPV, thereby helping to increase the wealth of the shareholder. Right? But again, the drawback is that again, it is complex. Right? And unlike net present value, where you are exactly knowing what is the return you are getting, here it's just a percentage. It's not telling you anything much about the profitability. So it is not a measure of absolute profitability. So the plus point in NPV is it is a measure of absolute profitability. So this is a good thing. But the downside of IRR is, again, it's a percentage. It is not a measure of absolute profitability. Right, so I'm putting the plus in green and the minus in red. Right, and of course, in order to get the accurate answer, see, you will get an estimate. Roughly this much is the answer. But in order to get an accurate answer, you will have to use a spreadsheet. And as I mentioned in our examples, when we are solving questions from the kit and so on, we will definitely use a spreadsheet. As of now, just ignore this point. Just ignore that point and ignore this point also. So these are the advantages and disadvantages of IRR. Okay. With which, again, technically, talking about two IRRs and all that, I don't normally believe in, like as I said, before we look at things like delayed annuities, delayed perpetuities, advanced annuities, before we go in, dig deeper into something, we need to know the outside of it. Once you know the outside of it, it makes sense to dig deeper into it. So that's why I haven't done advanced and delayed annuities and perpetuities and also two IRRs, because I don't want to like kind of, like you are just getting the hang of one IRR and already now we're talking about two IRRs. I don't want that to happen. Right? So this much you ensure that you are comfortable with, there is no problem with, and then it will make sense to look at what? To look at advanced annuities, perpetuities, delayed annuities, perpetuities, and also possibility of having two IRRs. So advanced and delayed annuities and perpetuities and IRR advance. So I'm going to put this in red, meaning that when I see you in the next class, I think which is on Friday, what I will be basically doing is I will be seeing that this is what we did on Wednesday. And I will see that this is something that was not covered on Wednesday, because I wanted you to be comfortable with annuities and perpetuities and basic of IRR. I hope by Friday you will have studied everything that is in green. So your understanding will be very strong. So it will make sense to go into advanced and delayed annuities and perpetuities. But apart from this, this chapter is done. Right? And this is our third chapter of FM. How many chapters are there in FM? I think about 20. Yeah, 20 chapters, 21 chapters. So we're moving to the fourth chapter of FM. And again, unfortunately, I will be only able to like brief on this chapter because it's already 4:38 and we stop by 4:50. No. For test on Friday, we will look at everything until Wednesday. This is like a rule, right? Make sure that everything until the previous class. Now, what is this chapter on? Again, it's investment appraisal, but further aspects of discounted cash flows will be looked at in this chapter. And okay, test will be uploaded on the LMS and you can access it on your LMS. Everybody has their own access and you can do it anytime before Sunday evening. So, I mean, again, there are people who are working also. So I don't want to keep it a specific time. So Friday we will upload, Friday, Saturday, Sunday, 3 days you have. Anytime at your convenience, you can do it and you will get the result also immediately. They will be MCQs. Monday's class and Wednesday's class both are okay. Today is Wednesday, but Monday's class is uploaded. Guys, please make sure. In fact, we have put a message, we've drafted a message, we haven't shared it yet. But the message says, Dear students, we have an important update for you. From now on, all your class recordings will be uploaded in separate units instead of being grouped under one unit. Again, we've done this for your convenience. Okay. This change will make it easier for you to access and review specific sessions. So instead of having everything under one unit, we've put it, kind of phased it out. Okay, so you have it. We try our best to upload the recordings immediately after the class. Sometimes, if it's a Sunday class or if it's like a late evening class, it gets uploaded the next day. But I'm sure FM is there because FM is not on weekends. FM is not in the evening, late evening. So FM is already uploaded. You can access it. Now we're looking at the next chapter, which talks about. Again, there is a brief introduction to what inflation is, but again, you need to know inflation is simply the rise in prices. I mean, I wouldn't want to spend 10 minutes, 20 minutes explaining what inflation is. Inflation is simply the rise in prices, the general increase in prices. Right? That is what inflation is talking about. Now, in this chapter, we're going to look at certain interesting concepts like, again, what? Inflation, interest rate, find the real return on the investment. And all of these things, which again is a kind of a reasonably big chapter. Okay. But again, I will try my best to finish the 4th chapter on Friday and move to Friday is our class, right? Let me just check. Friday or Thursday. FM, yes, Friday. Yes, I can go through an overall review, but that's why we have the last 10 minutes for, right? So we will do that. So Friday, we will try to finish and complete chapter 5 and finish things off. Chapter 4 and we'll move to chapter 5 on Friday. Chapter 5 is what? Lease versus buy. Okay. So this is what we've looked at. Again, I wouldn't want to start something new in the last 6 minutes. So as Nitesh mentions, I can quickly review and recap on everything. Advantages and disadvantages of NPV. Remember, advantage of NPV is that it is an absolute measure of returns. And we're taking into consideration time value of money. And we're looking at the entire life of the project. But what is the drawback of NPV? The drawback of NPV is, again, who can tell me what is the drawback of NPV?
Complexity.
It's complex. Manager may not understand. You will be, he might, but you might have to explain it. Right? And you need to know what the cost of capital is. You need to figure out what it is. Right? Then comes test your understanding 5. We looked at test your understanding 5. We're getting 10,000 in 4 years' time. So again, if the interest rate is 8%, all you have to do is 8% for 10 years. Look at the discount factor table. If you have done that, you will get the discount factor. Simply multiply the discount factor with this 10,000 to get the present value. Because remember, future value into discount factor is the present value. As simple as that. Okay. Then we looked at annuity. Annuity is basically getting a fixed amount of money every year for a certain fixed number of years. Right? For example, I explained what annuity is with the help of this illustration. We calculated it normally, but then I told you that instead of doing this, I can just add up all the discount factors to get like one factor, which can be used for all the 3 years, which is known as the annuity factor. So 1000 into 2.486 is 2486. Then we saw what is test your understanding 6. Again, the logic and the concept was the same. There was nothing new. You have a payment of 3,600 every year for 7 years. So you know this is an annuity. There is no doubt about it. So simply use the annuity factor table and get the answer. Okay. Perpetuity and perpetuity factor. Perpetuity factor is very easy. It's simply what? Perpetuity factor is cash flow divided by R. And what is a perpetuity? Getting an amount every year forever. And the formula is cash flow divided by R. Right? And growing perpetuity is the same thing. We'll just add one tiny minus G to the formula to deal with growing perpetuity. And based on that, we looked at test your understanding 8, both part 1 and part 2. Then we looked at internal rate of return. Internal rate of return is basically that rate at which your NPV is neither positive nor negative. It is 0. And based on that, we did our calculations of test your understanding 9 and 10. That's it. Right? With which the third chapter is over. So now again, I want all of you also to make a note of the indexes, because it will be very helpful. Every day when you start, you have an index. So you simply go through the index and see if you're happy with all the topics covered till date. That is, today is the third class. In the first class, we looked at all these 20 topics. You can make a note. Probably if you want, you can take a photo of it and make a note. This is what was done in the first class. This is what was done in the second class, which was on Monday. Again, you can take a photo and then make a note of it. But going forward, make sure that you are having an index, because it will be very helpful and easy to say, okay, this is clear for me. This I have a problem. Okay, all this is okay. Here alone I have a problem. So it will help. All the topics covered in class, you know it. And this is what was done today. The red things we will cover first thing on Friday. With which, again, guys, it is 4:50, I mean a few seconds to 4:50. So once you've taken photograph of all the 3 classes, whatever was covered, I want you to, again, till date I have covered 20, this 20, plus this 17. So 20 plus 17, 37, plus this 14. 37, 54 topics. For these 51, sorry, not 54. For these, not 51 also, for these 49 topics, because these 2 I haven't done. For these 49 topics, how much is your understanding out of 5? So you can review all the topics and let me know. Okay, so these 10 minutes is for that. And whoever has a doubt somewhere can type it. Whoever has your understanding as 5 out of 5 can let me know. Okay, good. Okay, and what questions to do in KIT? See, technically speaking, you have to do the entire KIT. But if you're referring to the topics that have been completed and only, like kind of filtering out those specific questions that relate to you now, that I can do. I will probably on Friday, I will tell you because by Friday, we have completed 4 chapters. So by Friday, I will tell you what to do. And a couple of them we will also record and upload on the LMS. Okay, calculation of IRR. Again, calculation of IRR is what? Remember, there is a formula, right? So which part of, do you not understand the formula or you don't understand the logic of IRR? Or sum is a problem. What is it? Formula, this is the formula, right? You are not required to kind of elaborate and explain on the formula. Otherwise, I would have done that, but that is like a kind of it's not needed, right? This is the formula, right? Here, what you have is the formula, right? The L here is the lower rate of interest. What do I mean by lower rate of interest? Basically, in order to calculate IRR, you will take 2 rates. Basically, you want to know that percentage at which NPV is 0. So you will take 2 percentages. One, the lower percentage, which I'm putting in blue. Probably that lower percentage will have a positive NPV. And a higher percentage, as I mentioned, as the cost increases, your savings go down, correct? So as your cost of capital goes up, your NPV will go down and will potentially become negative. So you need, in order to calculate this is what you're trying to calculate, the percentage at which the NPV is 0. In order to calculate that, you have to take 2 rates. One, the lower rate, and the other is the higher rate. One rate, the lower rate has to have a positive NPV, and the higher rate should have a negative NPV. So you know that, okay, if the lower rate is positive, if the higher rate is negative, somewhere between these 2 percentages, your IRR will be 0. Sorry, your NPV will be 0. For example, say at 5%, your NPV is positive 8,000 or say positive 800 at 5%. And at 18%, again, higher rate, at 18%, you have an NPV of negative 200. So you know that your answer, your IRR is between 5 and 18%. So you can take 5% as your lower rate, which will be L, will become 5%. and 18% can be taken as your higher rate, which is H. The NPV of the lower rate is NL. And the NPV of the higher rate is the NH. If you substitute this in the formula, you will get the IRR. Is that clear? Yes. So all of you type. Everybody, whoever hasn't, once you type, that's all. You can leave. Okay. Thank you so much, guys. You can leave. I will see you on
Thank you.
Friday. Thank you. Bye.